Hi everyone, it's Peter Schiff. This is Friday, April 30th, 2010. Well, a lot of people are excited today on Wall Street, although the stock market is not reflecting that enthusiasm. I think a lot of it is weakness in the financials, particularly with the downgrade of Goldman Sachs. I think the stock, last time I checked, was down about 10% on the day. It's a new low for the move. But the market is excited about the good news on the economy, that the economy grew by 3.2%. And everybody is happy, the recession is over, we've got all this growth, and of course powering the economic growth is the biggest increase in consumer spending in, I think, 3 years, something like that. Well, the problem in our economy has never been a lack of consumer spending. I've said that many times. The problem in our economy is an excess of consumer spending. The fact that consumers are out there spending more money when they're upside down in their mortgages, when they still have car loans and student loans, when they have nothing saved for retirement, the fact that Americans are spending despite all that, that is a bad thing. It's not a good thing. Sure, our economy is growing because consumers and our government are spending borrowed money, but the debt is growing faster than the economy. So we're poorer as a result of this GDP growth. We're not richer. And of course, all the money that we borrow to spend today is money we have to repay with interest tomorrow, which means we can't spend tomorrow. In fact, we have to reduce our future consumption by more than our current consumption to pay the interest on the borrowed money. So none of this is good news. This is all, again, a charade. This is phony economic growth. This is debt-fueled consumption, either by individuals or by the government. But what's not happening is that the economy is not restructuring along the lines that we need. We are not increasing our savings. We are not increasing our productive capacity. We are making all the same mistakes that we made before the bursting of the real estate bubble. And we can expect even more dire consequences as a result of this phony economic growth. One of the comments I heard made on CNBC, I missed the speech, but I know that Barack Obama gave some kind of press conference today, and apparently he wasn't as optimistic about the economy as I guess some of these reporters would have liked. And they were saying that, hey, he's the president. He should be more optimistic. He should be more upbeat on the economy because that way consumers will go out and spend even more money and really get the economy going. As if growth is all a function of spending. If the government can just say things are great, just buy that new car, take on more debt, max out those credit cards, go ahead, take out a mortgage against your house, spend it, everything is great, that's what we need. We need that like a hole in the head. All that is like a cheap high, but ultimately when the drug wears off, you have a bigger hangover as a result. And the fact that so many people are still so confused about what really constitutes economic growth is beyond me. Now also, part of the hype coming out of this report is the fact that there's no inflation anywhere in sight. And the reason that this is that the government's measure of consumer prices showed the smallest increase, I think they said ever, since they started keeping records back in the 1950s. Now, of course, in order to get that, they had to throw out food and energy, which, obviously food and energy prices are the prices that are rising the fastest right now. That's why they want to throw them out. Of course, everybody eats and everybody uses energy. So to say that inflation is low once you kick out food and energy, makes absolutely no sense when those are the two most important things that we buy every day. And look at the big increases we're seeing in food prices. Oil is back up at $86 a barrel. I think it's going a lot higher. I think you're going to see more strength in agriculture. But the biggest reason that the ex-food and energy prices were low was because you had a big drop, I think a 0.2% drop in rents and owner's equivalent rent. Well, why are rents falling? Rents are falling because you have a glut of property on the market and a lot of people who are unemployed. And so rents are falling because the economy is weak, despite the fact that the Fed is creating a lot of inflation. But the government is using the weakness in the real estate market and the weakness in the economy as reflected in the rental market as a sign that there's no inflation. Believe me, there is plenty of inflation, and it is going to run out of control even as rents fall. In fact, the higher inflation gets, the lower rents are probably going to go. Because, people have to eat, they need energy, but you know what? They don't have to pay their rent. And if landlords are getting a lot of tenants who aren't paying, they really have no choice but to lower their rents. And you know what people can do? They can move in with their friends, they can have roommates, people can take on boarders, people can move in with their parents, older parents can move in with their kids. There's lots of ways that you can consolidate your rental expenses. But you know, you can't really, I mean, you can trade down, you can eat hamburger instead of steak, but you have to eat something. So those prices are going to rise a lot faster. And of course, when Americans buy food, they compete with people in other countries who are buying food. When we buy oil, we compete with people in other countries. So you have the upward pressure. But if you're living in, in Detroit and you're going to rent property, you're only competing with other people in Detroit who want to rent property. You're not competing with people in Japan or people in Germany or China. They don't care about, an apartment for rent in Detroit. So if those economies are strong and ours are weak, we can have falling rents. But if the global economies are picking up, certainly they are around the world, particularly in Southeast Asia, that puts a lot of pressure on prices. Americans have to compete with people around the world, even as people around the world are getting richer. Now, also, if you look at what's happening in the currency markets, the dollar is still strong against the euro, but it's not really strong. The euro is weak. Gold made a new high for the year today. That would not be happening in a strong dollar environment. Also, look at smaller currencies. The New Zealand dollar hit a new high for the year today against the US dollar. So what is happening with the dollar is just temporary weakness with the euro. If we really had economic growth, gold would be falling, not rising, and the dollar would be strengthening against all currencies. It wouldn't simply be less weak than the euro. But as I've said before, the weakness in the euro is temporary. Yeah, there are problems in Greece, but ultimately I think what's happening in Greece is going to strengthen the euro, especially if they don't get a bailout. That's going to show creditors that the euro is a real currency, that if governments get into trouble, there's no bailout, there's no excess printing of euros. That's the exact opposite of what they will expect in the United States. And if you remember way back when the mortgage crisis started, people said it was contained to subprime. I was one of the only people out there that said no. It wasn't about a subprime contagion. It was always about the entire mortgage market. It's just that subprime was the weakest link in the chain, and that's where you saw the problems first. It took longer before you saw the problems in prime mortgages, but it happened. The same thing is happening with sovereign credit risk. First, we saw it in Iceland. Then we saw it in Greece. It's not about contagion. Many countries have too much debt, including the United States. And relatively soon, the United States is going to find its credit crisis. It's going to be in the same predicament where it can't borrow money. Interest rates are going to start to rise. And we're going to have to make a decision whether we default on our debts or print money. I think we're going to choose printing, which is actually worse than default. But we are going to be in that predicament. And remember, our national debt is about $13.5 trillion, and it's financed with short-term debt. The average maturity is under 5 years. I forget exactly what it is, but we have like a 5-year arm or less. And if interest rates rise, if they go up to 10%, there is no way we can continue to refinance the national debt with 10% interest. The American taxpayers will revolt, just like the people in Greece. If we try to impose an austerity, if we try to raise taxes or cut government spending sufficiently to be able to pay interest to our foreign creditors, they'll be rioting in the streets. So our day is coming, and it's coming soon. Meanwhile, we need to prepare for that. Also, I think it's a great timing. I had a book, my new book just came out, How an Economy Grows and Why It Crashes. And today's release of economic data is a perfect time for people to look at this book to really understand how economies actually grow. They don't grow based on spending. They grow based on the absence of spending. They grow based on savings, which means you earn money and don't spend it. That's where capital comes from. That's where real economic growth from. That's where you get the productivity. It's from not spending. But anyway, here is the book. Let me hold up my new book, How an Economy Grows and Why It Crashes. It is out right now on Amazon. You can buy it. You can buy it on my company website, Europac.net. Here's the back of the book, EUROPAC.net. You can also go direct to Amazon. The book will be available shortly, if it's not already there, at major bookstores. I think it's great. I think this little cartoon book will really help everybody understand economics. It's so simple, even congressmen should be able to figure it out. Hopefully, a few of them will get a chance to read it. Anyway, thanks a lot, everybody, for tuning in. I'll be back again soon. Have a good week.